Okay, so we are dealing today. The topic we are going to deal with is share valuation. Okay. Now, before we talk of share valuation, let's understand share. What is share? Share is that gives you ownership right, that gives ownership right or interest in what in a firm. Okay. So if you buy shares, you become what? A shareholder, right? And the share that you bought gives you an interest on a firm, the company. Okay. Now we have two main classification of shares. We have ordinary shares, graduates, and preferred shares, right? Now when we talk of preferred shares, that's a fixed rate that is paid. And when it comes to paying dividends, they are considered first before we go to ordinary shares. So we normally tell ordinary shareholders are the true owners, right? Okay. Now when we talk of let me move this thing for me. When we talk when you are a shareholder, there are certain rights that you will enjoy. Okay, you will enjoy, and some of this rights include uh, wow. I want to say something. Okay, I need it. I need to copy this. Okay, it's supposed to be it. I need to copy this. Put it here. Yeah, since you're talking about shares, I think it should be it. Okay, so let's continue. So let's want to know more about shareholders have right to vote and they have the right to purchase additional shares. So meaning that when a company wants to issue shares, existing shareholders have the right to buy the shares before considering potential or new shareholders. Okay. Now shares are traded in stock market or the financial market, right? Now stock market, we have two types of stock market. We have this one, the one we have stock exchange. When talk of stock exchange, shares stock exchange. When talk of stock exchange, we have like Ghana stock exchange, right? It's a physical location where shares are traded, okay? And it's made out normally it's listed firm that are public. Listed firm and the firms are normally large, right? So they trade them. But then we have over the counter. Over the counter is normally they don't have a physical location. Trading is done over computer, right? So and normally they are engaged by small firms, relatively small firms, okay? All right. Now, then can be traded in what? In what? In a financial market, right? In a financial market is initial corporate. That is raising shares. When you're raising new shares, then initial public offering. Then we have primary market for trading shares, for trading what new shares. Then we have secondary market for trading existing shares. And this is like what shares, right? I'm honest, I want to sell it. Right? So in selling it, I'm going to secondary market. That is it. Okay. Now we also have I think you know that shareholders have expect two benefits or have two benefits. They benefit in two ways, right? They benefit from dividends and what capital gain. What is dividend? Dividend is a portion of profit that is paid to shareholders, right? That portion of profit, if the firm decides to pay some else to shareholders, then you get dividend. Then we have capital gain or loss. Now, capital gain is, let's see, you bought shares, right? And the price that you bought the share, that means higher than the price that you bought the share. Then we say you have bought with capital gain. But when we say lower, then we say you capital loss. So let's use some figures here for a better understanding. So let's say you purchase so you purchase your shares at 0.90 pesos, right? Share per 5% was 90 pesos. However, you were able to sell it at what? 1 cedi. When you wanted to sell, you were able to sell at 1 cedi. You are making 10 pesos gain. This is capital gain. You have gain. Now, what if you sold it at 0.8? Okay, minus 0.9. This is going to give you a negative figure, okay? A negative of minus 0. So that's what? Capital loss. So that's what we are talking about, okay? So if you sell it higher than the price you bought it, you are making a capital gain. If it's more than the price you bought it, then you are making what? The capital loss. Okay, let's continue. Now we are going to share valuation. What is share valuation? I said in finance, anytime you hear of valuation, then we are thinking of discounting future cash flows. Okay. So they want to know the present value of the cash flows, right? The future cash flows. Okay. Now, so when you talk of share valuation, they're talking of present value of the expected cash flows from investing in shares. Are you okay? From investing in what? Yeah, so that's the present value. Okay. All right. So what do we get? Now we have two main ways of valuing shares. We have dividend growth model and corporate value model. Okay, corporate value model. I read let's move. Corporate value model, right? Okay, so we are going to use dividend growth model, right? All right, that's what we are going to learn for today. Now, valuing shares. Valuing shares. So this mathematical presentation of how shares. So I told you that you find the present value of the share value shares. So of the cash flows from the dividend. And the cash flow in this case is what? Is the dividend. So the dividend they pay for the first year, you discount it. The they pay for scale, you discount it, right? So we are using CM because we don't know how the question will look like. So if it's up to 10 years, we are doing that. So that's it. So now that will be only. Let's move. So we are taking an illustration, okay? We are taking an illustration for a better understanding. So we say a firm is expected to pay a dividend of what? 3.05 next year, 3.20 the following, and 3.5. So we have 3 years here, okay? 3 years here, okay? So to value the shares, let me use PO here. I'm using VS. This is the formula. Based on the question, we have 3 cash flows. So we'll be discounting 3 cash flows. We'll be discounting 3 cash flows. And this one is for what? Year 1. So we have the second cash flow, the second dividend with our discounting factor 1 plus raise the power 3. So we have, based on the question, we have 3A. So now the next thing is identify the information I'm going to insert into the formula. The first year dividend is what? 3.05 all over sorry, this is choose the rate to state in yeah, the state where we have to insert point 0.13. This is going to be 0. Raise the power what? 1 plus the second dividend is what? 3.20 all over 1 plus 0.13 the power plus 3.50 3. Okay, so that is it. Okay, so we go through the calculation, the second we go through the calculation. So this you would have to, it will become on 1.13 raised the power 1, 1.13 raised the power 1.13 raised the power 3. But to be fast, we just want to do all this will be 2.70 plus all this will be plus all this will be 2.43. At the end of the day, we are getting 7.4. They are all in Ghana City, right? Okay, so that will be that's my Ghana City. So that is it. Okay. The next thing we do is we assume perpetuity. When do we assume? Whenever we are assuming perpetuity, then it means probably okay. So whenever you hear as assuming perpetuity, it means that firm is as a reliable performer, as it's performing very well for a long time and it's constant over a long period of time. Okay, so we are doing perpetuity and from time value of money, I talk about assuming what perpetuity. Why is this moving? All right, so we talk about assuming perpetuity. Okay, now in that place it was the sole value of shares. So PMT, payment over R. So this one says paying a constant dividend over a spread of over rates or cost of capital or whatever will be given there. All right, so let's read this question. I don't know why this thing is moving. Okay, so let's read. A private share has a par value of 100 and a dividend of 10.7%. It is if the required rate of return 10%, what is the share value? So assume perpetuity, so that will be 10.7. We want to find 10.7 of this to give you 10.7 over what? 0.1. Okay. What is happening? This thing is not supposed to move. I don't know why it's moving. Okay. I don't know what is happening, but which is equals to 107.50. So when you are doing perpetuity, that is it. Okay, it's not moving again. So that's the answer. Okay. Now, the instances where we assume what? Constant growth. And when you talk of constant growth, we are talking of when I talk of constant growth, we are talking of where this particular firm is going to grow, is going to grow its dividends at a constant growth figure. Okay. So the firm will be like every month I'm going to grow the dividend by 10%. We know that every month the dividend will grow by 10%. So there's always an increase, but it's constant. Okay. When that happens, there's no period. Now, whenever you according to what you hear now, I will. Whenever you pay dividends now, the result is DO, right? DO. Okay. DO meaning that immediately the following year will be D1. Okay. So this is the formula, right? They are growing the dividends. The dividend being grow by 1 plus whatever rate is given, right? So if it's 2 years, second year are going to grow, then the time is going to affect it. That one is going to what? Discount them because they are still looking for the value for the firm. Okay. So let's stop this question. It says Kaiser ordinary shares has paid a dividend of 10%, which is expected to grow at 15% for the next. The shares have a required return of 2%. What is the price invested would be willing to pay for the shares? Okay. So now let's go. It's 3 years. It's going to be DO. What is the dividends they paid now? Then you're going to grow it. Okay. So this will be the formula. This should raise to power 1. Okay, but 1, whether bring it or not. Then we discount it, of course, since you are looking at the present value, plus rate. Okay, raise the power 1. Plus. So when you solve this, and you'd have gotten D1. But this one, since you are not using P, I say you are still using the beginning amount, as in the now paid dividend. This is plus. I then have to correct this. That'll be what? 1 plus R. Raise the power 2. Okay, let me get my eraser. and erase this. Oh, what is happening? Ah, okay. All right. Okay. Then we have the third year. This is a mistake. It's not cross. I don't want to if I leave that sort of thing. This is the power of 3. That's great. Okay. And 9 is okay. So now we have to identify the information and send the appropriate for basis. So we have what? D0 is what? 10. It is going to grow by what? 15%. That will be 1 plus 0.15. Okay. Raise the power 1. You can sign it to make it 1 the power all over 1 plus the rate that was given was what? Rate of return is 20%, 0 point. Is about what? 1 plus, okay, 10 growing by 0.15% for what? 2 years. So you ready for is about this thing. Oh gosh, it might not go there. Okay, let's see. Plus that raise about 2 plus when this will go there. 10. Oh god. 1 plus 0.15 raise the power 3. Okay, that's great. All over what? 1 plus 0.20 raise the power what? 3. Okay, so like let's go. So that is it. The rest is mathematics. So you add this and raise up, you add this, you raise up. Okay, let me just do a little bit. Okay, so this will be 10 into bracket 1.15 raise the power 1 all over 1.20 raise the power 1 plus 1.20 1 raised the power to all over what? 1.2 0 raised the power to, I don't know why I'm still bringing bracket, but anyway, raised the power what? 2 plus what? 10 times 1.1. Okay, so that is it. That is it. So that is any we are finding board mass. So you do the bracket for you raise this power to this to power and this to power to this today. You raise this to this before you multiply and all that. But for time's sake, we are going to be fast. All of this is going to give us 9.58. Okay, plus all of this is going to give us 1.8 plus all of this is going to give us so we are going to get what? 27.5. So that's it. Okay, so that is constant growth. Okay, all right. Okay, and the constant growth too, we can assume what? Perpetuity. Perpetuity, and this be the formula. We can assume what? Perpetuity. If the growth is constant, can assume perpetuity as long as the growth is less than the rate. We can what? Assume what? Perpetuity. Okay. Okay. So if you are assuming perpetuity for this one, it would have been value of shares. This one has okay, it has 1 over 10 all over. The rate is what? 0 point. I don't know. Let me see whether we have a question. Okay, there's a question. So let's solve this question. So the expected dividend per share on equity share of Road King Limited. The dividend per share of Road King has grown over the past 5 a rate of 5% per year. The growth rate will still continue for future for I will continue forever in future. What is a fair estimate of Road Limited if the required rate is 15%? Okay, so that's it. Okay, so that would be what? That will be value of shares is equal to this, right? Dividends, dividends over. So what are you getting? The dividend from the question is let us see the question. Understand it. Say the dividend is 2, right? It's only somehow when the growth is less than what? The rate, okay? And we have the rate for 15%, that's 0.15. And the growth is what? 5%, 0 point what? 0.05. Okay. All right. So this thing. Then the price is what? Then the answer will be what? That is run will be what? So it will be 2 over 0.10, which at the end of the day is going to give us 20 rand. Okay, because the currency was in rand. Okay, now let's come to the final part of valuing shares. Okay, now we have non-constant or supernormal dividend growth model. Okay, non-constant or supernormal growth model. In this, you see that normally these are normally like this. Normally, 12, 12 growth and at the point they say forever. So that we are combining equal constant is unequal constant forever. And when you get into research a question, that's how we solve it. First, you calculate the what expected dividend for the period which involves normal. So you grow each of the dividend based on the activity. Then calculate the price per share for the final period of supernormal growth of non-constant growth. That will mean discounting the what the forever amount of the first forever amount. Because every time you are valuing anything, you are discounting. If you are buying for year 3, you discount the value, the cash you are bringing for year 4. They discount it. So that is it. So discount cash flow after you discount the cash flow of the different and the price that of the calculated for the period. Okay, so this is the formula. So this is the discounting the price. The things that you should know. PO is the market price, DO is the current dividend. Okay. Capital gain. Well, so there's a question. Right? I'm going to understand this very well. We have 2 questions here. I'm going to solve just this one. Let me see if maybe I don't know what I'll solve this one. But you let me understand the question. The Christchurch ordinary shares has paid a dividend of 6%, which is expected to grow at 18% in the first 3 years. And from the 4th year, the growth will be 7% per year forever. Forever. The share has a required return, that rate of return, 20%. What price is investor willing to pay for the value for the share? What price is investor willing to pay? But when the investor is buying shares, they normally value it so that they will not overpay, overvalue the shares. When they overvalue the shares, to be a loss to them. Okay, to minimize their risk, they will value the shares. Okay. So now they said according to the procedure, the first thing we do is what we grow the dividend. So we are going to grow it one by one. This one is equal. That by not get equal. So let's see. Let's go. So for the first year, then we are getting the want to get the first dividend. That will be equals to 2 into brackets 1 plus 10. Okay. So that is going to give us first brackets, this is okay. This is this. Okay, that's plus what? 1 plus 0.18 plus 18. So what are we getting? We are getting 7.08. In when we're solving the first one, we grow the constant amount by 2. But this one, since we have the D1, to get the D2, we can just grow the D1. We don't need to grow the D0 by 2, okay? Or we don't need to grow it by 2 and square. So we can just take the D1 and grow it to be for the second year. So that'll be 1 plus bracket close is equals to dividend is what? 6 bracket open. We have sorry. Okay, so the D1 is this. Okay, sorry, D1 is this 0.08. Okay, plus 0.8 point 5. Okay, then we have what? D3. Now D3 means we are going D2. This is the answer for D2. So that will be D2 1 plus 10 is equals to what? 8.35. One plus 0.18. That's what? 9.86. So now we've done the first part. So then they said that the final period before we move to the forever, we find the price for that final period. So we're going to find price for what? D3. So that will be what? P3. And to find the price for B3 will be what? You have to get the dividend for 4, but you have to discount the year before the P3, and since we have rate and growth, so that's it. So how do we get this D3? Okay, to get sorry, how do we get D4? Okay, to get D4, we have to what? Grow D3. So that will be D3 into bracket 1 plus 10. Okay, the space is small, so let's continue here. Now, D3 is this. So that would be 9.86. Okay, bracket open. We have 1, which is a constant, 1 plus root. Now you can see that the growth for the 4th year was 7. So that was 0.87%. That would be 0.0 7. So this one you are going to get 10.55 when you calculate it. When you calculate it, get 10.55. So now let's solve for the price. Let's solve for the price. Now we have D4, which is 10 point what? 10.55 all over. The rate is what? 20%. So we have 0 point what? 20 minus 0 point. Please, you are using the growth forever, right? Growth forever. Okay. So we are this one we are getting 81.1. So the next step is we discount this, and discount it, and we have the value. Okay. So that would be so it means that the value, the formula is saying we should discount all the dividend we've calculated. So that what D1, we discount D1, 1 plus R raised to the power 1 plus D2, 1 plus R raised to the power 2 plus D3, 1 plus R raised to the power 3. Then we are going to discount the price. Okay. So we raise the power 3. Okay, so let's insert the information. Okay, just I think I want us to see. You see D1, D2, D3. We have what? Price here. Got 811. Okay, please note D4 is not part. D4 is only relevant for us to get what? The price for the final period of supernormal growth. Okay, so we have 7.08 all over 1 plus 0.20 raised to the power 1 plus 8.35 all over 1 plus 0.20 raised to the power 2 plus D3 is what? Now you got 9.86 base the power of 3. Then the next one is what? The price, which is 81.16 all over 1 plus 0.20. Not printed because it's not going there, right? 1.20 is minus 1.2. Okay, where's the power 3? So now let's go. So when the equation, all of this is going to give you 5 points. Oh. $5.9 plus all of this will give you 5.80. Then all of this will give us 5.71 plus okay, so this all of this will give us this. So at the end of the day, we are getting 64.38. And then solve in the lecture notes. I'm solving it again. Okay, so well, that is it. I hope you understood it. I would like to solve a second one. The second one. But this one is like the first amount too was kind of the same. I want something different because it was different. This question is quite short. So I'll solve it. And it said Red Sun Rising just paid a dividend of 2.80. Just paid means D0. Just paid D0. The company said that it will increase the dividend by 25%. 20% over the next 2 years, respectively. After that, the company is expected to increase the annual dividend by 3.5% forever, right? Let me add forever. Okay, so if the required rate of 10 is 12%, what is the share price today? Determine the present value. Okay, today. Okay. So now let's solve the question. The procedure said what? Solve the supernormal growth first or the non-constant growth first. Okay. So we know that D0 now the paid dividends just paid dividends. So that is 2.88. And so it's going to increase it over 2 years. So let's get our D1, right? Our D1 will be D0 1 plus 10. And this is going to give us, we know D0 to be what, 2.88. I pray it goes there. Over 1 plus. The first growth is what? 25%. That will be 0.2. So let's bring the answer here because it didn't go there. So we are going to get 3 points. So I'm losing 3.60. Okay. All right. Then so we calculate. We do for D2. Let me bring it here to go the D2. D2 is equals to 3.6. D2 will be equals to, let me bring D1. We have to grow D1, right? So this will be equals to 3, since D1 is 3.60, we have 1. The growth for the second year is 20%, okay? So that will be what? Plus 0.20. So what are we getting? Oh, that is good. Oh, okay. Okay, so I don't know what was happening, but let's recalculate this. Okay, so that will be 1 plus 0.20. Okay, so what are we getting? We are going to get 4.32. Are we okay? So that is it. That is the supernormal growth period. I told you that the second step is to find the price, the value for the last supernormal growth period, which is what? D2. So meaning that we are going to work for the price of D2. And I said to get, you have to discount the previous dividend. That will be D3 over R minus 10. Okay. All right. So that is it. So how do we get the D3? How do we get the D3? Okay. That will be D3. D3 will be growing what? D2, right? 1 plus 10. Okay. So now we know D2 to be what? 4.32. 1 plus. So let's look at growth forever. Growth forever. From the question reading. Sorry, I don't know why this thing is moving a lot. Anyways, and the question, the growth forever was what? 3.5%. Okay, so that would be 0.035. Okay, so what are we getting? All right. So note that these three are getting for purpose of we getting what? The price of what? Okay, let me use my calculator because when I move this thing, it's giving me a lot of problems. Let's go to calculator. The calculator is what we get for this. That'll be 4.32, 4.32. The open bracket, that'll be 1.035 bracket close. So it will give us 4.47, right? Two decimal places. So now, meaning that you to get the price for the year 2, you are going to have 4.47 all over. Now, what's the rate? The rate is what? 12.5%. So that is 0.125. Okay. Hope you understand why you got it. Then minus growth 12 super the forever constant growth, which is what? 0.035. So let's see what we get for this. The answer we get for this. So that is what? 4.47 divided by 0.125 minus 0.035. Okay. So we got 49.67. Okay, so that's what we got. Now they are saying after that we should discount all the dividend required for the supernormal growth period and the price. So meaning value of shares is going to be equals to D1 over 1 plus R raised to the power 1 plus D2 all over 1 plus R raised to the power what? 2. Then I said this one to what? P2. This one is not coming. I said the purpose of calculating this is for us to get the price, right? So we have P2 over 1 plus R raised to the power what? 2. Okay. Don't know why this thing is not moving. Okay, that's great. Okay, now let's continue. I think we have. So this will be equals to where is the first? This is the dividend, D1 dividend. So that would be 3.60 all over 1 plus what's the rate? You have to go up there to check this. 12.5, right? So that would be 0.035. 0.125 plus the second, the D2 is what? 4.32 all over this. This is raised to the power 1 all over 1 plus 0.125 raised to the power 2 plus price is what? 49 point plus 7 1 plus 0 point let's move. Okay, don't know what is wrong with this thing. It is giving me a lot of problems. I've never thought where point 1 1 2 5. Okay, all right, so we want to know this one to okay, so we want to know what we got for all this. So all this is giving us what? 3.20 plus all this is giving us 3.4133 plus all this is giving us 39.2533. And when we add all of them, we are getting 45. 45.87. Okay, so that is it for the second one. I wanted to solve the second one so that you understand. I don't know why today, because I've never thought for this thing to move like this before. I don't know what is happening today. Okay. Now, that is it. So, but we want to understand efficiency market. Okay, when you talk of efficiency market hypothesis, this is where we assume that the stocks are always at equilibrium. Then it's very difficult for someone to beat the financial market because it reflects all the information. So therefore, you cannot beat. And we have 3 levels or 3 forms of efficient market. We have weak form of efficient hypothesis. When we talk of weak form, it means this type reflects historical price of the yes, and therefore you cannot base on the historical price of the shares too. outperform or beat the stock market. Then we have the semi-strong form of hypothesis, efficient hypothesis, and that one is saying that reflects past price and publicly available information, meaning that when you have the historical information, you have publicly available information, you cannot beat the firm, you cannot beat the shares because it's reflecting these two information. Then we have the strong form of efficiency hypothesis. That one is saying that the shares reflect every information, the historical price movement, the public available information, and insider information. No insider information is very hard to come by. Therefore, you cannot outsmart, you cannot outperform, and you cannot outperform the stock market, or you cannot consistently make profit on it. Now let's come to preference shares, right? What is preference shares, right? I've said before that preference shares is one of the classification of shares, and for them it has fixed rate and they are paid earlier. Now we say preference shares are hybrid. When we say hybrid, it means the thing has two forms. Hybrid because it can either be shares or it can be a bond. Why is it a bond? Bond because it has a fixed rate that they pay, just like bond holders receive fixed rate, they also receive fixed rate. Two, it can be likened to bond because they are paid before ordinary what? Shareholders. Okay. Now we can still say it is shared because if preference shares for some reason they are paid, you cannot declare the effect that it has gone on bankrupt. But if you don't pay bond, we can say that we have gone on what? Bankrupt. Okay. All right. So to value preference shares is since they pay fixed rate, fixed dividend. So to value preference shares, to be given what the dividend is constant. So the only thing is that it has a period that it ends. Sorry, it doesn't also have a period that it ends. So you can also bring the rate. Okay. So if you have a dividend of maybe 7 cedis and a rate of 20%, that will be about then you are getting 35. So that is it for share valuation. Okay. And so if you have any question, you put that in the comment section. Our next lecture is probably going to be capital budgeting. I've already taught more valuation, so we're going to do capital budgeting. Okay. All right. So that is it. So I'm ending the meeting.